South Africa, we face an unprecedented moment in history. We stare down an unseen enemy that threatens to overwhelm our healthcare system, crumble our economy, and break our spirit. But through unfaltering leadership and swift, decisive action, we are fighting back. So, this is it. Lockdown. The army has been mobilized. Our doctors and nurses have taken up arms against this aberrant adversary. And the call has been sounded for us to stay home, self-isolate, and stand in solidarity to save lives. We may find ourselves alone, but in a world so intricately connected by technology, we're in this together. We are united, apart. But what do our lives and times in lockdown look like? Well, that's up to you. Show us how you're getting through and what lockdown means to you by sending us your video clips, images, voice notes, or anything that captures the essence of this extraordinary event via WhatsApp or email. Each day we will choose our favorite submissions to be featured as a daily snapshot of lockdown life and share them to our social media channels under the hashtag #UnitedApartSA. The submission of the day will also receive 700 Rand. When this is all over, our favorite submission will receive 5,000 Rand, and we will use all the content we have collected to create a documentary so the world can see you, South Africa, and how we came together during our time apart. Many of us will need to start over, to rebuild. And so all the proceeds from this historic film will go to helping those in our local communities affected by this terrible pandemic. Now is the time for us to come together and unite apart.
Okay, hello everyone and welcome to today's webinar. My name is Fatima Vauda. Our topic today is rebooting the global economy in the era of a pandemic. And our speaker is 274 CIO Chief Investment Officer Nadir Token. Before we start, allow me to take you through a few housekeeping measures. The webinar will end at 11 a.m. We have allocated a total of 15 minutes to take your questions. So if you do have any questions during the presentation, just type them into the question box in your Zoom control panel. We will pick them up on our side and try and answer as many of them within the allocated time frame. A recorded version of this webinar, together with the slide deck and quarterly report, will be made available within the next 24 hours on our website, www.274.com. We would love to hear from you. So please do reach out to us. So coming into 2020, many of us in the investment community, regardless of some of the potential headwinds that the economy could face, were fairly optimistic and had penciled in respectable returns from global capital markets for the year. In fact, in January this year, the IMF projected global growth to come in at 3.3% in 2020. Then COVID-19 happened. And in April, the IMF revised the global growth outlook to fall to -3%. This is a downgrade of 6.3 percentage points from January 2020, a major revision over a very, very short period of time. This makes the Great Lockdown the worst recession since the Great Depression and far worse than what we saw during the global financial crisis. Equity markets have fallen substantially, and governments across the world have announced stimulus packages to aid both workers and businesses that have been very hard hit by the coronavirus pandemic. The US put together a colossal $2.2 trillion economic relief package, which was more than twice the size of President Obama's $830 billion stimulus package of 2009. Under extraordinary pressure to salvage an economy on the verge of collapse, in South Africa, we saw 200 basis points rate cuts in quick succession, and on Tuesday evening, President Ramaphosa announced a 500 billion rand COVID-19 economic stimulus and social relief package. So in order to make sense of all of it, the 27-4 investment team have compiled a set of themes which we believe will influence the flow of capital as the global economy emerges post-lockdown, which our Chief Investment Officer will unpack shortly. We are also acutely aware of the anxiety and panic faced by our fellow South Africans. Our data indicates that large numbers of savings have switched their retirement and other savings from growth portfolios into money market investments, locking in substantial losses and entering an asset class that is no longer attractive given the 200 basis points rate cut. History has also demonstrated time and time again that markets in general always recover following a crisis. Whilst we do not know how long the recovery could take, what we do know is that if you are not invested, when that bounce happens, you could miss out on the recovery. We urge you, therefore, to act wisely during this period of uncertainty and seek the necessary guidance and advice to assist you in making any decisions, and to not act with haste. I will therefore also request our Chief Investment Officer, Nadir Token, to touch on our expectations for the equity and fixed income markets, which will be helpful when you make those difficult decisions. So now, without further ado, we will turn our time over to Nadir Token, CIO at 27-4. Welcome, Nadir.
Yeah, thanks, Fatima. Thanks for the introduction, and good morning to everybody. I hope you're managing to stay safe and healthy at home during these difficult times, and certainly unprecedented times indeed. So I'm going to be running through the 5 biggest themes that we see affecting the flow of capital in the global economy post the COVID-19 pandemic, and how we're seeing this playing out. So this is just an agenda for today. So the 5 biggest themes that we see impacting the flow of the capital, the first one is obviously the impact of COVID-19 on global growth and risk appetite. As Fatima mentioned, the sell-off in global financial markets has been severe. The investor psyche is severely battered, and a lot of guys are asking questions as to where to from here. And that leads quite nicely into the second theme, where a lot of investors are de-risking to money markets, as Fatima alluded to. The issue with this, of course, is that you never know when is the right time to get back into the market. So, in this theme, we just kind of unpack what has happened in previous economic crises and previous market sell-offs over the course of history, and how markets have reacted, and what our thoughts are around the outlook for risk assets going forward. The third thing is, I'm sure many of you would have seen on Monday nights at one point, West Texas intermediary oil futures in fact plunged below zero. And what that means is that oil producers were actually paying their customers to take oil off their hands because there's nowhere to store oil. And this obviously, this big crash we've seen in the oil price has major ripple effects into the global economy, and we'll just unpack some of those. Political risk is something that's ever present, but in a time like this, becomes exceptionally more heightened, and the impact of it is more severe in terms of business confidence, consumer confidence, and what that means for the recovery post the COVID-19 lockdown. And the final theme we're going to chat about is, I'm sure some of our more astute investors will be aware that, value has been, as a style, has been out of favor globally for a very long period of time. Quality as a style continues to get more and more expensive. And we unpack some of our ideas around this and why we think this has been the case. So if we just head on into the first theme for today, so the shock to the global economy has been exceptionally severe. Fatima has alluded to how the IMF has downgraded growth. This chart just unpacks some of that in a bit more detail. South Africa has obviously not been spared from this, with the IMF now expecting almost a 6% contraction in South Africa's economy for 2020. And this is revised from, just a meager below 1% in October of last year. So the biggest problem for South Africa is that we are already on a very weak footing heading into this crisis. And this has just pretty much compounded a bad situation for South Africa. If we look at world output, as Fatima mentioned, a 6% swing in the IMF's expectation for global growth. And obviously these major revisions downwards to global economic growth has meant that investor and business confidence has been very negatively impacted, and investor psyche has been very negatively impacted. If you look at this chart over here, essentially, this is what we call the fear index for the US, and it's basically the VIX index, and it's basically a measure of how volatile are US equity markets at a point in time. And while we have receded off our intraday lows that we saw during the heights of March, at one point, the VIX index, or the US equity fear index, had actually surpassed those levels that we had seen during the financial crisis. So I think that sets the backdrop quite nicely for just how severe, the impact on risk appetite has been in the global economy, and how heightened fear is at this juncture. Moving forward, then, if we're talking about, our expectations for when we think this will abate, or when we think that we'll see a recovery in investor sentiment, one of the key metrics that we're watching is flows into emerging markets. And what we've put on this chart is South Africa specific. Now, a number of market participants may argue that South Africa has a lot of idiosyncratic risk, meaning that, we had a weak fiscus and a weak balance sheet heading into this crisis. We had a number of, ratings agencies, pretty much all three ratings agencies were on the cusp of downgrading us, most importantly, Moody's into junk status. And as a result of that, South Africa is not necessarily a fair reflection of risk appetite globally. What we've seen happening in South Africa is that we've seen strong outflows from our bond and equity markets. In fact, if you look at the brown line in this graph, we see cumulatively somewhere in the region of 450 billion rand in outflows from our financial markets so far this year. And the rand has obviously reacted to that, and we've seen a blowout in our currency from a starting value of around about 14 rand 30 to the dollar at the start of the year, to at its worst point in excess of 19 rand to the dollar before the end of March, and we've kind of retraced back to those levels. The one point I will make is that this is not just what's been experienced in South Africa. Emerging markets in general have suffered $90 billion in outflows year to date to kind of the end of last week. And this is really a theme that we have seen. So, one of the themes we are watching quite closely is that when we see these flows reversing and we start to see strong inflows into emerging markets, that's when we'll know that investor risk appetite has returned somewhat. And we're starting to see the investor psyche getting over the damage that was done, by COVID-19 and the lockdown thereof. And as investor sentiment recovers, that's when we see confidence filter back through into stock markets. We could see potential re-ratings of equity. And that's when we see the recovery that Fatima alluded to, which can happen quite quickly. That's when we see the recovery happening, is when that investor psyche recovers. So that leads quite nicely onto the second theme. So if we look at, when to risk and de-risk, we thought it would be quite instructive to look at what happened historically within financial markets. So what we've done here is we've looked at the US equity market pretty much over the last 50 years. And we've said, if you look at the red bar, that's basically, the intra-year drawdown for a particular year. If we look at the brown bar, where there was a yearly loss, that's what the yearly loss was. And what we see consistently happening where there's the brown and red bars is that historically, we see a big overreaction in equity markets to some news events. So whether it was the oil price crash of 1970, whether it was Black Friday of 1987, whether it was the Asian financial crisis in the late 90s, whether it was the dot-com crash in the early 2000s, whether it was the financial crisis in the mid 2000s, we see this major overreaction initially, and then equity markets pull back from that lowest point. And in fact, in extreme circumstances, even in the year positively. So this is exactly what's happened so far in 2020. We've seen a recovery off of our worst point. We're not saying that this is necessarily the starting point of a sustainable recovery. To give an indication, during the global financial crisis between September 2008 and December 2008, we saw the market bounce north of 20% on 6 separate occasions and give those gains back. But what we are saying is that if you are able to cut through the noise and take a long-term view, ultimately equity markets do recover off their lowest point, but there potentially is some further volatility to come in the short term. If we look at the JSE, the JSE has kind of been no different from history, from global markets rather. And essentially what you see is that, if you look at the column that says the peak PE, so basically the peak multiple, that's basically a very important determinant in how severe the market sell-off is. So basically in the early 70s, the oil price crash, the PE was quite high, which is why the stock market recovery sell down was very, very severe. And really the only exception to that was 1982, where we're coming in on a fairly low PE and we still saw north of a 35% decline in equity markets. Having said that, if you look at the 1980 crash, the 12-month return subsequent to the lowest point was exceptionally strong, with you more than doubling your money. And even on a 2- and 3-year view, exceptionally strong returns from that point. If you look at the global financial crisis, that will be pretty fresh in everybody's memory. The PE was kind of just above average heading in. The sell-off was quite severe, at north of 40%. The recovery 12 months and 36 months out was again very strong. So far in this recovery, we've already seen a 30% drawdown. So I think the very surprising thing about this recovery is just how severe the sell-off has been in a very short space of time. You look at that, it's only 1 month so far. So at the starting PE was quite high relative to history, on a trailing basis, because obviously the JSE listed companies have been battling to generate earnings growth. We'll wait and see how this crisis plays out. But I think the takeaway from this is that, much like global financial markets, on the local side, we see a strong sell-off and an overreaction in reaction to an economic crisis. We potentially still a way away from that. But if you look at it over the medium and longer term, those returns are more than recovered over the longer term, and investors are rewarded for maintaining patience and waiting for risk assets to recover. So I've ultimately said a lot with regard to when is the right time to de-risk. I want to be conclusive about what our views are. So in summary, if we look at our views are really maintain a healthy allocation to risk assets. Don't try and time the market, especially in the current environment, because, guys who are thinking of de-risking and going to cash, the bottom line is that you're getting 2.25% less return on cash than you are getting at the start of the year. So to contextualize that, long-dated money market funds are giving you, instead of 8.5% that they were giving you at the start of the year, they're now giving you sub 6.5% on a 12-month forward-looking basis currently. And that's assuming that we get no more interest rate cuts from this point. With the oil price sinking to the extent it has, and with very little demand-side inflation, it's not a given that we're not going to get further interest rate cuts. So, trying to lock in the losses you've had in risk assets and go to equities, is not a sound strategy as far as we're concerned. However, investors should be very aware that they need to stick to their long-term savings plan. They can't be capitulating on that and trying to time the market in the short term now, because there is still an exceptional amount of uncertainty within the global economy. We need to see how fiscal packages play out. We need to see how the monetary packages that central banks have announced play out. And we need to see what is the impact on company earnings. That's going to be the most important factor to consider. We've got to recalibrate our expectations for earnings on a forward-looking basis. And if those downgrades to earnings are more severe than what, the sell-off has implied, we could see ongoing volatility in the equity markets into the near term. So, and on the back of that, we'd say certainly within 27.4, despite the severe sell-off we've seen, we're not going significantly overweight risk assets at this point in time. We are waiting for more information with regards to the discourse for company earnings, risk appetite, and watching emerging market flows closely on that point. And then the third thing we're watching closely is, the economic impact of the fiscal and monetary packages. So if we move on to the third theme that we think is going to be driving capital allocation, and I think this is very topical at the moment, is the oil market. And I think a lot of guys are underestimating kind of the knock-on impact that depressed oil prices are going to have onto the global economy, both in positive and negative. Obviously the fundamentally positive, structural positive kind of outlook from a lower oil price is that terms of trade of countries like South Africa are going to be drastically improving. Our inflationary outlook is going to be very benign into the medium term because of a lower oil price, which is somewhat offset by a weaker rand, but not completely, given how strong the oil price sell-off has been. And what we thought some of the negative impacts are going to be the job losses we're going to see in the US, which is going to mean a slower recovery in the US, slower consumption in the US, and that ultimately filters into confidence and company earnings. So what we thought we'd do is unpack why we're seeing what we have within oil prices. And what this chart shows, which is from the International Energy Agency's report of April 2020, is what oil demand and supply has been. And what we're seeing is generally world oil production and world oil consumption very closely track each other through time. And OPEC Plus as an organization very closely monitors that. We've now had COVID-19, which means that demand has essentially fallen off a cliff, by roughly around about, 12 or 13 million barrels of oil a day. And the producers have been very slow to react to that. We saw a spat between Saudi Arabia and Russia. Eventually, they've come to a deal to cut 9.7 million barrels of oil out of supply, out of daily production, should I say. But that really has not moved the needle in terms of the oil price because the damage has already been done, in terms of oversupplying the market and very little place to store this oil. And we very clearly see this in this picture with a big demand drop coming into Q1 of this year. That's expected to increase into Q3, but that really then just brings demand more in line with supply. And it's really only into Q4 and into 2021 that we see demand outstripping supply and a drawing down of the already built up stock in the oil market. So if we look at how severe is the built up stock in the oil market, essentially where we've got a maroon bar on this chart is when we're adding to global oil stocks. And where we've got that beige brown bar is when we're drawing down on stock. So we see during Q1 2020 and during Q2 2020, we're adding a phenomenal amount to already high stockpiles. And that's the reason for the capitulation in the price. And we really only start to see a drawdown of those supplies into the latter end of 2020 and moving into 2021. So really, we still have to deplete all the above ground stocks before we have a marginal severe upward pressure on oil prices, which is why we expect oil prices to be fairly depressed into the medium to long term. If we look at the trickle-down impact into financial markets, what we've really put over on this chart is what corporate credit spreads have done on the back of the collapse in the oil price and also on the back of the impact of COVID-19 and what that is expected to do to the global economy. Essentially, this is the largest spike in corporate credit spreads, so basically the rate that companies can borrow at over the equivalent sovereign. This is the sharpest rise in corporate credit spreads since the global financial crisis. And what this means is that it increases the cost of companies borrowing. So companies have to pay more interest. If they have to pay more interest, it means they have less profits to distribute to their shareholders. If they have less profits to distribute to their shareholders, that means that it impacts the expected return from equities. And if we look at the flow diagram over here on the right-hand side of this chart, this really just talks to, how the lower oil price filters through into confidence and ultimately into stock market returns. So what we see is that we've got a supply glut results in the prices crashing. Shale companies really need oil prices in the region of $40 to $45 a barrel. Even the most efficient producers need a north of $40 oil price. So when we see these oil prices at sub $30 a barrel, that places severe strain on these guys' balance sheets and on these guys' cost bases. Ultimately, that means that they potentially have to increase the number of layoffs that they're doing. And with 20 million jobs already lost in the US economy, that places further strain on the labor market. And what that means is into the medium to long term, that means that the recovery in consumption within the US is much more stuttered and much slower. And that ultimately weighs on corporate sentiment, on corporate investments, and on corporate earnings, which means that the stock market recovery is delayed as a result, all the way filtering down from the top as a result of lower oil prices and its impact on the US economy. So we certainly think that this is a near to medium term risk for the US economy and for stock market recovery, and is perhaps adding to the additional volatility that we're seeing in global financial markets through April, where it hasn't necessarily been one way up. We've seen days of severe drawdowns as well. So these are the sentiment issues which is ultimately weighing on the market's expectation for growth and consequently the multiple that these equity markets can trade on. If we move on to the fourth theme that we think is going to be impacting the flow of capital, it's really going to be political risk and what impact that has on confidence. We've mentioned confidence consistently throughout this presentation. The reason confidence is so important is that if we want a stock market like the JSE to go from an 8 times forward multiple to a 12 times forward multiple, we need investors to feel confident that profitability is going to return to normal. And the same goes for US equity markets as well. We've seen a derating from north of 20 times earnings to around about 15 times earnings at the peak of the crash. If we want that to get back up towards 20 times earnings, we need market participants to feel confident that a recovery is going to come through. And one of the things that is going to weigh on this confidence is political risk within the global economy. So if we look at the fiscal stimulus plans that governments have tried to inject into global economies to try and counteract this, these fiscal packages have been huge. Fatima mentioned the $2.2 trillion announced by the US. Remember that this is just money that's spent by governments. This is excluding what central banks have done. And the Federal Reserve has added a further $2 trillion of stimulus over and above the $2.2 trillion fiscal package. If we look at Japan, the government of Japan has done $1 trillion. The Euro area has cumulatively done around about $350 billion. China has been very aggressive on this front. And in fact, as Fatima mentioned, even South Africa joining with around about a $500 billion package, which translates to just about $26 billion in dollar terms using the prevailing exchange rate. I think more importantly, though, is to focus on those red dots. How big are these fiscal packages relative to the size of these economies? And you look at South Africa's fiscal package, President Ramaphosa really stepping up to the plate in terms of government's reaction, with this fiscal package being equivalent to that of the US's in terms of the size relative to the size of the economy. Japan really being aggressive at 20% of the economy, and other developed markets ranging anywhere from around about 3 to 6% of GDP. So governments have tried to step in with fiscal packages, but the reality is we still have ongoing tensions between the US and China, and COVID-19 has accelerated those. We've seen that the US has pulled their funding from the World Health Organization, accusing them of having a close relationship with China and helping China cover up the impact of the disease. We're seeing that Brexit still needs to be negotiated. We're seeing tensions within the Middle East, and we've chatted about the oil price. So ultimately, governments have tried to inject fiscal stimulus packages, but there's still a lot of uncertainty about. If we just turn our attention to the South African fiscal response and break down some of the numbers, as we mentioned, President Ramaphosa announcing this on Tuesday night, 70 billion rand in tax relief, 200 billion rand, a loan scheme fund guaranteed by National Treasury, which has been set up to provide any business with a turnover of under 300 million rand with support during this period. 50 billion rand in direct poverty relief, and some of the horrific stories you hear about people starving as a result of this COVID-19 crisis, and that pushing them to desperation. Increasing the social grant, increasing the child grant, that's a big chunk of that 50 billion rand. 100 billion rand set aside for job relief. Very early estimates indicating that there's anywhere between 400 and 500,000 jobs in South Africa that are going to be lost just as a result of the lockdown. And hopefully that 100 billion rand can alleviate some of that. And then 20 billion rand set aside for the immediate medical emergency as a result of COVID-19. So South Africa is really trying to come to the party on the fiscal side, noting that we already have very limited room to maneuver, given our accelerating debts, our ratings downgrades, and an already expected 10% fiscal deficit of GDP. The problem, of course, with fiscal packages, and what we've done over here is we've tried to break down how crises have panned out over the last 3 occasions, and government's responses and the economy's responses rather to that. And what we've seen happening is that there is a big impetus from government spending, as we can see in this chart, just under 1% cushion to the economic contraction from government spending. However, this is completely dwarfed by the lack of private sector investment that's coming through into the economy as a result of reduced confidence. So the problem over here, ladies and gentlemen, is that if we don't sort out the political uncertainty, and if we don't sort out the spats between countries and what impact that's going to have on economic growth, businesses are not going to invest. If businesses are not going to invest, there's no fiscal package that's going to be able to offset the complete kind of drawdowns that we see from a lack of investment that we've seen in previous crises, and it's going to be quite difficult for investor and business confidence to improve. If we move on to the final theme then that we think will be impacting, and this has really been something that has been very topical and very almost controversial in a way. There's never been a longer period throughout history where value has underperformed quality for this length of time. Here we try and unpack some of our thoughts around what happened and what we think is likely to be the case going forward. So what we've looked at is the sell-off period, which is basically mid-February to mid-March. And we've taken all the 9 subsectors on the S&P 500, and we've said, how have these 9 subsectors performed relative to what their historic beta should have implied they performed, and how have they actually performed? And what we've seen is that the value segments of the market, so if I look at real estate, if I look at consumer discretionary, if I look at energy, if I look at financials, those segments of the market have massively underperformed what history has indicated they should have performed. And if we look at the quality segments of the market, if we look at the likes of consumer staples, the likes of healthcare, the likes of information technology more recently, these segments of the market have really outperformed what investors would have historically expected. So essentially, we've got this dynamic at play, and it's really been at play for an extended period of time, where companies that generate high levels of free cash flow, that are generating relatively stable earnings growth, that have negligible or even in some instances negative net debts on their balance sheets, or are very conservatively leveraged. These are the parts of the market which have continued to outperform the rest of the market and prove to be a highly defensive and a protection to investors, to equity market investors. So why has this been the case? And really, why has it been the case over the course of the last 10 years? This has really been the case because companies that generate a high amount of free cash flow and they basically don't have to take on a lot of debt in trying to grow their company, because they can use retained earnings and free cash flow generated from the business to fund their growth, in terms of capital investment. The second point is that high free cash flow generation enables these companies to, not be as aggressive in terms of revising their dividend policy as a company that has a stretched balance sheet. If you have a stretched balance sheet and you're excessively geared, if you get a downturn in your business, you've got more of your cash flow has to go to servicing debt. Whereas if you're a high quality company, that's not the case. So you can continue to maintain or very minimally cut dividends to shareholders, and that supports total returns to investors. And then the final point is that a high free cash flow generation company can really afford to be very opportunistic during distressed times like this. We've seen equity markets at their worst point sell off some 35%. If you've got a high retained cash balance on your balance sheet, you can do very opportunistic mergers and acquisitions. And what that can mean is that you can grow your market share. You can structurally deepen your moat around your business and your competitive advantage. And that ultimately protects your long-term capital growth or your long-term, rather earnings growth, should I say. And as a result of that, shareholders are, cognizant of this, and the share prices of these companies tend to be a lot more defensive during difficult times. So if we turn our attention to, how this theme has played out in the JSE, essentially, if you take the all share index as an overall composite index, the quality of the all share index has been deteriorating over the course of the last 5 years. We've seen a massive ramp up in the total debt to equity, as indicated by the gray line. And and very disappointingly, we haven't seen commensurate improved returns to shareholders, with the return on equity really remaining flat or even slightly declining over the course of the last 5 years. And what that ultimately means is that, this could be a large part of explaining why returns on the JSE have been so poor over the course of the last 5 years. It's kind of just anecdotal evidence of why quality is so important and why it's very important to maintain your total returns to shareholders, especially when you're taking on a significant amount of leverage. And that's really where I'll wrap up, the themes. And then if we're moving on to our outlook for the asset classes, the sell-off has been severe. And if we look at how this has impacted our asset allocation, while we've moved from an overweight to a neutral SA equity position, that doesn't mean we've been selling SA equities. It just means that the reduction in SA equities that we've got as a result of market movement, we're not topping that up to get back to a massively overweight position. And I think we've unpacked that earlier in the presentation as to why. In terms of bonds, the excessive sell-off that we saw in bonds with at one point yields getting above 12%. And that was really implying somewhere in the region of 7 to 8% long-term inflation in South Africa. It was quite clear to us that had been overdone. And as a result of that, we used the opportunity to get overweight bonds relative to our strategic asset allocation. And we've already started to see that theme play out, with bond yields contracting all the way back to under 10.5% today. Ultimately bonds benefiting off that. Inflation-linked bonds, we were quite underweight heading into the COVID-19 sell-off. What we've seen is a sharp steepening of our inflation-linked bond curve, with the entire curve shifting upwards, but also the long end shifting higher a lot more than the short end. And what this means is that this has presented some very exciting opportunities within the inflation-linked bond market, given that our real yields have gone higher. And should we see a surprise inflationary shock, inflation-linked bonds would be quite a good hedge against that inflationary shock, which means that, we've gone from an underweight to a more neutral position. Our listed property allocation, unfortunately, this is an asset class where we see some structural headwinds for a very long period of time. I'm sure all of you have heard the very emotional call from the CEO of Edcon, Grant Pattinson, that has been played as a result of the impact that the lockdown will have on their business. Some 800 million rand in lost sales over the initial 21-day lockdown period, and that is likely to be worsened now that the lockdown has been extended by 2 weeks. Basically, it's very uncertain whether Edcon is going to be able to reopen their doors, and that's expected to have a 1.5% impact on listed property companies' dividend yields. If we look at, Truworths, Pepkor, Fashini, all joining the call for saying that, they're going to be paying fractions of the rent that they're supposed to be paying for the month of April, and for as long as the lockdown is going to be around. And, that's ultimately going to impact a lot of the operating cash flow of these property companies. And although the yields optically look very appealing at this point in time, we think that the earnings and the distribution base need to be recalibrated significantly lower, which means that, the current yields are just optical and are not sustainable into the medium term. And as a result of that, the kind of downweighting we've seen as listed property as a result of it selling off some 50% so far this year, we haven't we've just continued to maintain from an underweight position, continuing to maintain a significant underweight position within the asset class. On money markets, we continue to maintain an underweight position. As I mentioned, a 2.25% reduction in the 12-month forward yield on money markets. That could potentially go lower if we see further interest rate cuts, although it is a buffer against short-term volatility. And as a result of that, we're not cutting our money market exposure even more significantly than the underweight we had coming into the crisis. In terms of the offshore equity, we've gone from more neutral to overweight. At the start of the year, we were neutral because we thought we could get in the region of 8 to 10% earnings growth, a 2% dividend yield. However, we thought that the multiples were, fairly fully valued, so we weren't going to get multiple expansion. As a result of that, we weren't overweight the asset class and we trimmed it to more neutral. The market movement as a result of the severe rand weakness has taken us to an overweight position within this asset class, and we're going to continue to maintain this overweight position. We think that diversification in this environment is critically important. We think that, a rand hedge is critically important, and ultimately these equities have sold off to multiples that are more in line with or even below long-term averages, which means that, this is not the most unattractive time to be maintaining this overweight. But again, it's not necessarily meaning that we're buying more offshore equities attractively at 18 Rand or 19 Rand to the dollar. We just, as a result of market movement, we continue to maintain our existing overweight position in the asset class. And then if we turn our attention to global listed property, this is an asset class we continue to remain fairly excited about. We've got a 4 to 5% distribution yield from this sector. We think this distribution yield is a lot more defensive and a lot more, sustainable than what it is for the domestic listed property markets. At a 4 to 5% distribution yield, you're talking about somewhere in the region of a 3.5 to 4% or 4.5% yield spread over equivalent government bonds. Even if you only get low double-digit earnings growth with rental contracts being negotiated lower, even if you only get low double-digit earnings growth, for the year 2020 or 2021, that still takes you to a mid-single-digit total dollar return for the asset class, which we think is a compelling investment case. With regards to global bonds, we continue to maintain very little, if any, exposure to the asset class. We think that yields are artificially depressed. Governments are going to spend a long time repaying the amount of debt that they've stacked up. And as we showed in the earlier slide with the latest fiscal responses, they've just indebted themselves even more. And bond yields where they currently are basically completely dependent on interest rates remaining structurally where they are into perpetuity, which we find very hard to believe they will. And as a result of that, we continue to remain structurally very underweight the asset class where we do maintain any exposure at all. So that really wraps up the formal part of the presentation. I'm going to hand back to Fatima, who's going to coordinate any questions that there might be, and I'll be happy to take any questions.
All right. Well, thank you very much, Nadir. So with that, we'll go ahead and take some time for questions. A lot of people have been asking the question on whether this recording together with the slide deck will be made available. The slide deck and the recording will be made available to everyone on our website within the next 24 hours. Go to www.274.com. We have received a lot of questions. I believe there are in excess of a couple of hundred people on this call. So we've received quite a few questions and we're going to try and get through all of them. I must admit that there's a fair amount of consistency amongst the questions asked. So we may actually be able to answer a lot of them. So let's start with the first question that comes from Nicholas. Nicholas asks that, has the downgrade really been overshadowed by the COVID-19 sell-off? What happens at the end of April when SA bonds is reweighted in the World Global Bond Index? What about the potential further outflow of capital? And what kind of impact will that have on bond yields and currency? I just think that so much has happened since then that the downgrade has really just been overshadowed. So Nadir, maybe you can answer Nicholas's question.
Yeah. Well, Nicholas, I think thanks for your question. And, first of all, I'll start off by saying I completely agree with you that the downgrade has been completely overshadowed by the COVID-19 sell-off and the risk-off sentiment. There's been a lot of concern about what happens when reality hits home. Everybody realizes South Africa is sub-investment grade. And at the end of April, we've got this big bond rebalancing and we're going to get outflow of capital from our markets. I think that there's a very interesting article that I read which kind of tried to put an estimate as to how severe the outflows from our bond market are going to be. Now, the first point that we have to make is that not every foreign investor in South Africa has only an investment grade mandate. So it doesn't mean that all our foreign holdings necessarily are going to be liquidated. The second point is that even the guys that do have an investment grade or the tracker funds that do track the World Government Bond Index, it's very few funds these days do full replication. What they do is something we call stratified sampling, meaning that they take the most significant weightings within the index. So with the World Government Bond Index, you can replicate somewhere between 98 and 99% of the total return experience of the index by holding just the top 15 instruments, of which South Africa doesn't feature. South Africa is only a 0.4% weighting within that index. Basically, a significant amount of the passive money which tracks these indices are not even holding South African government debt. So the sum total, and then the other point becomes, there will obviously be some guys that are holding the debt. If they want to have zero tracking error as an example, they have to hold South African government debt. So then the question becomes, what is this estimate of outflows that we expect? And the sum total is that the number comes somewhere between $2 and $7 billion in outflows from South Africa's financial markets. With the strong outflows we've seen, as I mentioned, 450 billion rand over the course of February and March, that has already been preempted by a lot of these foreign investors. Yes, there is going to be some volatility in our bond market leading up to the downgrade and the exit of these investors. Although we think that this is going to be very transitory, and we've already seen, the rand shoots out to around 19 rand to the dollar. Our bond yield shot out to over 12% yields on our 10-year bond at one point. And we've seen that retracing all the way back to under 10.5%. And even as we get closer to that bond rebalancing, we're seeing our bond yields remaining fairly stable, indicating that a lot of the guys who are going to be forced sellers of South African government debt have already exited. I'm not saying that doesn't mean there isn't going to be short-term volatility, but even with bond yields at 10.5%, Nicholas, the reality is that we're pricing in somewhere in the region of 6 to 7% inflation in South Africa. Inflationary print at the last print was 4.5%. Arguably going to be significantly lower at the next print, given what's happened with oil prices. So we are a long way away from that 6.5% priced or 6 to 7% priced in inflation. And at 420 basis point credit default swap spreads, basically the cost of insuring against the South African defaults, our CDS spreads are in line with countries that are well into sub-investment grade. So we think over the long term, even post the rebalancing, the impact on the bond market is going to be fairly muted.
Thank you, Nadir. I just want to get to many of the questions. So if we can just keep the responses a little bit more brief. So Koos asks the question, why is there a different approach to offshore bonds versus local bonds?
Okay, so in summary, it's about the starting yield and about what expectations are built in for inflation within the various economies. So the starting yield in South Africa is significantly higher than globally, even when adjusting for the higher risk or a sovereign spread for South Africa, and even after adjusting for higher inflation in South Africa. So, Chris, the summary of it is that after adjusting for sovereign risk, after adjusting for inflationary risk, the bond yields in South Africa are still too high, whereas in the global environment, after we adjust for sovereign risk as well as inflationary risk, the bond yields are just far too low.
then we have a question from Warren, and Warren is dealing with a subject that is quite critical at the moment, in that given the level of retrenchments we're seeing from corporate South Africa, there is a potential liquidity crisis that could be faced by retirement funds. We've seen the Australian government come in with an approach also recently, making an announcement that retirement funds need to support the fiscal stimulus as well. So when we talk about country duty, are there any good examples that you've seen of retirement funds playing their role towards country duty?
Yeah, so I think this has been a debate that has been on the South African agenda for quite a while in terms of what role should retirement funds play within structurally improving South Africa's economic growth and structurally improving the highest levels of inequality pretty much in the world. I think that South African retirement funds are generally, trying to engage that debate a lot more constructively just outside of COVID-19. And that's where we've seen a lot of allocations, the likes of infrastructure debt, allocations, the likes of private equity supporting the mid-market segments of the South African economy, because ultimately that's the largest creator of jobs and driver of economic growth and tax revenue. And I think that retirement funds are likely to continue, to engage down this path. Obviously, COVID-19 puts a bit of a spanner in the works because of a liquidity crunch. But these are not debates which we can have with a short-term lens on. These are really debates which we have to have with a medium to long-term lens on. And we've seen a very positive reaction from a number of South African retirement funds willing to engage.
Let's take Shanel's question. Shanel wants to know if you've been using the weak rand as an opportunity to repatriate offshore assets.
Okay, so selectively on select funds we have, depending on the risk profile of the fund. So on our very conservative funds, where we have some offshore exposure, we have been using it as an opportunity to repatriate. But on our more moderate and aggressive funds, we've really just maintained this offshore exposure. As I mentioned earlier on when we were going through the asset class outlook, diversification is important in this environment. South Africa was very weak heading into this crisis, so it's going to be quite a challenge for us to deal with a number of our challenges. I mean, early estimates are that government debt to GDP are now going to go from just, around about just under 70% in 2021 to just under 90% in 2021 as a result of the coronavirus impact. We're going to get some relief on the balance of payments because of the weak oil price, but ultimately, the with risk appetite still quite depressed, we find it hard to believe that the rand is going to be structurally very strong, on kind of a 12 to 24 month view. We think that there might be patches of strength, but I think this is going to be offset by the fact that when we get the rand strength, we're going to see global risk assets rallying exceptionally hard, which is going to offset any rand strength. And we think that the diversification benefits in this environment, are exceptionally important for investors that have the time horizon.
All right. Nadir, just on that question, a lot has been spoken about the oil price, and we've had a question from Ramatua, who has asked the question, what ultimately for the ordinary South African, what does this really mean, given the price the drop in the price of oil?
Yeah, so for the ordinary South African, this is actually fantastic news. It's almost like getting another 100 basis point cut in the interest rate, because what it means is that, or maybe not 100, maybe 50 basis point cut in the interest rate, because what it means is that the price of petrol is going to come lower. Initial estimates are that we're going to get up to 2 Rand cut in the petrol price. Despite the rand weakness, we're going to get up to 2 Rand cut in the petrol price, in the first week of May. And that's ultimately going to mean it's going to cost less to fill up your tank. If you use public transport, hopefully, the taxis, etc., pass on the cost savings onto the commuters. And ultimately, you as a consumer are going to have more money in your pocket to spend every month as a result of petrol costing.
All right. Michelle is concerned about management in companies, JSE-listed companies, holding back dividends during distressed environments. Does it not show up the quality of management faster? And what about the recovery of such companies? So why is there such a negative response from investors?
Yeah, so I think, Michelle, first of all, I'd like to say that in composite, you are quite right. I mean, obviously, there's select examples where companies have done phenomenally well. So, I can refer to a company like Clicks, which is phenomenally cash generative, probably going to be increasing their dividends, because there's been an exceptionally well-run company. But in composite, your comments are valid, that generally, companies have battled on the quality perspective, they've leveraged too much, and as a result of that, when they get a slowdown in the top line earnings, dividends come under pressure. In terms of the recovery from this period, Michelle, I mean, as financial market investors, it's ultimately about what is baked into the price. And at an 8-time forward multiple, we are saying that a lot is already baked, a lot of negativity is already baked into the price. There is going to come a time where, these companies are going to be resuming their dividends, particularly the financial stocks, which have been hard hit, and from a dividend perspective. And, and then the total return will kind of commence to shareholders. But you're quite right in terms of noting that the short-term impact on the JSE has been as severe because the earnings growth and cash flow growth outlook for these companies have been impaired, and it's going to take probably a little bit longer than some high-quality companies globally for that recovery to take hold. Having said that, our market is trading on a lower multiple, so you are compensated for that additional risk.
All right. We've got Willem. Willem's very concerned, like everyone else, if you're an intermediary currently in the financial markets, it's very, very difficult to provide advice to your clients. And he's raising a very important point here. How does he actually convince his clients to remain invested and stick to their objective and stick to that long-term strategy, given what's going on? He doesn't know how long it's going to last. None of us professionals can even give him that advice and tell him how long it's going to last. But how do you convince people that are panic-stricken, very anxious, to remain calm and stay fixated on that long-term objective?
Yeah. So, Willem, I think the important part the important issue to address here is by saying to putting the facts across to your client, is that the bottom line is that we can de-risk your portfolio in this environment, and we can increase the proportion that goes to money markets, which is basically the safe haven asset class domestically. But the reality is that all you are doing then is crystallizing the losses you've already experienced. History has told us that as long as you have the time horizon on your side, and this is a very critical point, you have to have the time horizon on your side. But as long as you have the time horizon on your side, history has indicated time and time again through crisis over and over again, risk assets do recover. And by cutting your risk asset exposure now and going to money markets, all you are doing is preventing yourself from experiencing that recovery in risk assets and locking in these losses. You are basically guaranteeing the fact that, you are going to have a lower value to retire on when you do eventually decide to retire. And potentially guaranteeing that you are not going to be in a position to be able to retire over the long term, because money market currently at around about 6% is not going to be sufficient to meet your long-term demands for income post-retirement. And you are guaranteeing that by locking in these losses and going into money markets. However, if you stay the course and withstand the volatility, provided you have the time horizon, and I'll stress that again, provided you have the time horizon to wait out the market recovery, you basically then going to be at a point where you're going to recover all of these losses at some date in the future and compound your wealth at a more aggressive point, at which point then you can look at de-risking your portfolio and banking some of the profits that you've had.
Yeah. All right, Nadir, I think there's two parts built into this question from Zahid. And Zahid is asking a very important question, and I think we dealt with this during theme 2 when we talked about de-risking and re-risking. So if you look at the Rand now, right, at 19 Rand, you want to pick up risk internationally. You're a South African investor. Would you then buy dollars at 19 Rand and invest in the MSCI world? So that's one. And the second question is, if you were parking your money in the money market space and you wanted to jump into the domestic equity market, would you do that right now? So this is not someone that is currently invested in the market, sitting in the money market space. Yeah.
Fun. Yeah. Okay. So let me answer the first question. I think as South Africans, we tend to be, and rightly so, because we do have a very volatile currency, but we tend to be overly obsessed with the rand and, where it takes total returns. I think as an investor in an equity market, whether it be, as an investor in global equity markets, the case you have to lay out is, how does the rest of my portfolio look? What elements will global equities be bringing into this portfolio? And ultimately, what diversification will it be bringing into my portfolio? South Africa is only 0.3% of the global economy. What opportunities will I be accessing? I'll be accessing opportunities which are structurally going to grow a lot faster than a lot of the opportunities I can access on the JSE, accessing opportunities that are going to be not that impacted by COVID-19 and the lockdown as some of the opportunity sets I have on the JSE. And as a result of that, I have to structurally have this offshore exposure as a diversifying element to my portfolio. Once I get over that hurdle and say that it is important to do that, I then consider the exchange rate. And given that the exchange rate has depreciated materially, I'd say that, you probably want to average your entry points into global financial markets, not kind of allocate everything offshore in one go at 19 Rand to the dollar, but certainly start to get into the market at this point, because global equities, as we talk about the Rand having depreciated to 19 Rand, but global equities have sold off to the same extent. So the reality is that in Rand terms, global equities have done nothing so far this year. So, you're getting in at a fairly attractive dollar multiple, although you're going to get an opportunity to get in at a more attractive point when the Rand does eventually retrace, which is why I'm saying average your way into the market. The point I'll stress is that in this current environment, generally, when we're seeing the Rand strengthening and then basically your offshore return being impaired by Rand strength, it must be noted that this is going to be happening in a risk-on environment where investors are going to feel more confident about the prospect for the global economy, and as a result of that are buying emerging markets, and that's why their currencies are strengthening. If there's a risk-on environment, equities are going to do very well in dollar terms in that environment. So any loss that you might have from Rand strength is going to be offset by hopefully, the dollar value of those equities going high as a result of risk on sentiment and the multiple of those companies expanding. On the second part of the question with regards to money markets, if you're an investor who was in money markets, you are basically now buying the JSE at levels cheaper than you could get it at the depth of the financial crisis, if you exclude NASPERS. So if you exclude NASPERS, you're buying the JSE on an 8.3 times forward multiple, on a 4.5% dividend yield. Some 70% of the earnings on the JSE are now Rand hedged, meaning that they're not necessarily facing the domestic economy. So if you think about companies like Naspers, British American Tobacco, Anheuser-Busch, Bidcorp, these are all companies which are going to, witness very little structural and permanent decline to demand for services from their business and permanent impairment to revenue. And you're basically buying these companies at, a much lower multiple than you could have, over the course of the last 5 years. So I definitely look to start rotating out of money markets into equities if this was my starting position.
All right. Thank you, Nadir. We've had a phenomenally overwhelming flurry of questions that have just come through. And I'm really worried because we've run out of time. We are going to make the slide deck and the recording available on the website. Unfortunately, for those of you that have allocated the strict hour, we're going to have to end the webinar soon. And I do apologize for that. We regularly host these webinars and we will take note of your questions and perhaps reach out to you outside of this meeting. So it looks like we've covered what we could within the time frame. Nadir, is there any last parting words from you that you wanted to cover before I wrap up?
Yeah, I think maybe just 2 words: keep level-headed, keep cool, and stick to your long-term plan, as difficult as it is in this environment. All
right, great. Thank you very much. Before we sign off, and particularly to those who are not too familiar with our brand or our products and what we pride ourselves on, I will spend just a minute speaking to you on some of our flagship portfolios. So on the global side, we have two UCITS compliant global portfolios. We have a global equity portfolio and we have a global bond portfolio. Global balanced portfolio. And both those portfolios are available on the Old Mutual International platform, as well as the Sanlam Glacier platform, the international platform of Sanlam. Our global equity fund has outperformed the MSCI World Index since inception of the fund in 2013, and is available in dollars, in sterling, as well as in rand. The Global Balance Fund has also outperformed its benchmark since inception, and is available in both dollars and in sterling. So please have a look at those two global portfolios. It's extremely difficult. There's less than 1% of managers internationally that consistently outperforms the MSCI World. So we're quite proud of our track record in that space. Our risk profile suite of Regulation 28 Balanced Fund Unit Trusts all have an 11-year track record and have consistently been top quartile performers in their respective collective investment scheme categories. They've also been consistent winners of both the Raging Bull and the Morningstar Awards. And these portfolios, we really pride ourselves in terms of our skills in managing those portfolios, because they require a significant amount of experience, particularly when it comes to implementing asset allocation views. These portfolios are available for tax-free savings, for preservation, for retirement annuity, as well as for living annuity investments. So before signing off, on behalf of myself and the rest of the team at 274, I would like to thank our frontline workers for their sacrifices in their fight against coronavirus. So with that being said, please do stay in touch. We would love to hear from you, and we would love to visit you after the lockdown. Send an email to info@274.com or visit our website, www.274.com, and get in touch with us and learn more about us. Also, please do participate in a campaign that we've teamed up with Arena Holdings on, called United Apart SA, where you can send your clips and you can follow the hashtag United Apart SA. Thanks again for joining us today, and we will see you again next time. Hopefully that will be out of lockdown, and that will be soon. Stay safe and goodbye. Four, five.